Right. So is your business future ready? Is it resilient enough to handle any price shocks that might come your way? And are you ready to take the opportunities that we'll have in the future? Now today I'm going to talk a little bit about some bigger picture data, and then we're going to have a look at some specific ANZ data that we've pulled for our Canterbury group and look at a few numbers there. And then lastly, Mark's going to sum up with some insights and stories he's gleaned from his long career. Now, my first foray into dairying was basically as a child. I grew up on the good old 100-acre, 100-cow dairy farm in Taranaki. And in those days, the amount of supplement we fed on farm was pretty much limited to how much silage Dad could pitchfork onto the back of the tray of the tractor, or when it came to wintering, how many conventional bales of hay he could pile on the back of the tractor. And I think the limit we got to was either 16 or 18 plus 3 daughters on the back of the tractor. So yeah, not too many health and safety concerns those days. Unfortunately, our farm was quite undulating. We were kind of on the edge of the dairying region with sheep and beef farms across the road from us. So there was a few times that me and my sisters and the load of hay didn't quite make it to the destination. But I guess that's resilience, and that's something we all learn from and all benefit from over the long term, and it's something our businesses certainly can benefit from too if we position them accordingly. So today, firstly, I'm going to look at some of the trends that we're seeing in the global food markets. So we're seeing consumers wanting to understand a lot more about where their food is coming from, and a lot of them are concerned about specific attributes of that food. So we're seeing things like natural, free range, grass-fed, sustainable, traceable, animal welfare. And so a lot of these things we're doing really, really well already. There's certainly areas we will need to continue to push into. But I think the challenge for us really is that our consumers are on the other side of the world, and there is a big gap both geographically and in terms of information about that flow of information from us understanding what consumers want, and then consumers also understanding what we're actually doing on our farms. So I think that's one thing we'll see gradually change over the future, and I think we need to, is sort of bridging that gap between consumers and farmers. So I think some of the headwinds, we do have a few headwinds for the dairy industry in the short term. I mean, we've certainly got milk price volatility will continue, that's a given. We do have potential for costs to rise in relation to environmental costs and also the labour market. I mean, the labour market's extremely tight across New Zealand at the moment. It's not just hard to get labour on dairy farms, it's hard across all sectors. And we do have high debt on our farms, so we'll look at that in a bit more detail going forward. And land values are no longer trending up, so that's a challenge we need to work within. So firstly, in terms of milk price volatility, we're exposed to a much higher level of volatility than many of our competitors. And that's really because virtually all the product we're selling is going into those global markets. But we need to see this not so much as a problem, but look at it as an opportunity. If we can farm profitably during those low milk price years, then we've got some great opportunities during the higher milk price years. I'll move the slide. It might be moving. There we go. Right. So dairy commodity prices certainly do move around a lot. So what we see is we've had some really big peaks and we've had some really big troughs. And the last few years, prices have been slightly more balanced. But we need to be running systems that when we do get those peaks, that we can actually pay back debt and position our farm accordingly, so we can manage through those lower period times, and we can take any opportunities that come our way. So in terms of global milk supply, this graph's pretty much showing the year-on-year changes from the various main dairy exporting regions. So when it's above the line, we're seeing growth, and when it's below the line, we're seeing a contraction in milk supply. So at the moment, you can see we're just sort of coming out the end of a period of really, really strong growth. And that's really been driven predominantly by growth coming out of Europe. Now, we only produce a small quantity of milk in the world, and we've been very much driven by growing that volume. Now, I think the opportunity going forward is not so much in the volume, because we'll see there's much bigger producers out there, but it's in the value that we can extract from that milk. So we've seen some changing trends in the last few years, and this really relates back to consumer preferences. So we've seen a massive lift in fat prices relative to protein prices. And while fat prices are trending back now, that's really been driven by those consumers who agree that fat is now a good thing again. We're seeing a lot more liquid milk being consumed around the world in full fat format rather than as skim milk, and we're also seeing the trend back towards including fats in your diets. I mean, one of the great trends that's been running for a few years in the US is this bulletproof coffee, which is basically a black coffee with a dollop of grass-fed butter in it. Must be grass-fed, and that will set you up for the day. So while I haven't been brave enough to try it, it's probably not too different to that black coffee my dad used to take to the cowshed and squirt a bit of cream into. So maybe he was just ahead of his time. But these trends, are continuing. We do expect fat prices have come back, but we do expect they will continue at higher levels than what we've seen through the past decade. Now, if we look at dairy sector debt, now this is quite scary, and if you talk to other people around the world about the level of debt we have on our farms here in New Zealand, they generally freak out, really. They're really surprised that we do have such indebted farms. Now, those debt levels have crept out. This is New Zealand-wide data, but what it is hiding in here is the fact that there's huge variation on farms. So there's a lot of farms with much higher debt levels than these, and there's also some farms running very low debt levels. But certainly during that low milk price years, we've generally lifted our debt levels by $1.50 per kg of milk solids. So we weren't really resilient enough to manage through that downturn without adding debt. Now, what we've seen with land prices is land prices really rocketed up up to about 2010, and then they've sort of largely plateaued off and even coming back now. We're certainly seeing a lot of farms on the market right now, and some of the farm sales that have gone through are definitely coming through at a discount. I mean, as usual, when you see a bit of a downturn, the better farms are holding their value to a greater degree than some of the more marginal farms, or farms that are in an area where there is risk of substantial increases in costs or restrictions in production due to changes in environmental legislation. So what we do at ANZ, we run a business confidence survey, and if we extract the survey results for our agricultural people who participate in the survey and compare that against GDT prices, you see a close correlation in these two series. So basically what that's telling us is that when commodity markets are high, our confidence in the industry is high, which is probably no real surprise, and this is sort of linked to investment decisions as well. But I certainly do challenge, is the best time to invest when the markets are high, or are the best opportunities really at counter-cyclical when the markets are low and not everyone else is jumping in. So what we tend to see is that the businesses that are well set up and resilient are positioned, do position themselves to take advantage of times like we're in now, where confidence is low and they're not having to compete as hard on those investments, whether it be on-farm investments or expanding farms. Now, we did a survey earlier in the year around how many farmers' views in terms of the impact tighter environmental rules would have on their farm profits. And the majority of farmers found it would have a reasonable significant impact on their profits. And then we kind of had 37% saying it would have a minor impact. And of that 37%, I think we've got a range of recipients within that. There's certainly a small minority within that who are a little oblivious to what's happening out there in terms of changes. We have a portion of those who have actually are kind of ahead of the game, and they already have their farms reasonably well set up and for any changes that may come. And then there's a group of farms in there too that do have low debt levels and are reasonably well positioned. So any changes, or they can absorb extra costs without having a major impact on their profitability. Now, I think it's really interesting how much the change that we've had in the amount of palm kernel that we're importing and using on our farms. So now more than 10% of the milk that we produce in New Zealand can be directly attributed to palm kernel. So I think the challenge is, if we think back to that first slide around what consumers are looking for and what consumers want and where we can extract extra value, I think we do have to challenge ourselves around is feeding PKE what our consumers want. I mean, what we've tended to see is a lot of PKE starts to get fed when there's a drought, and there's a real genuine need to fill a shortage. But what we generally find is that doesn't actually come out of the systems going forward. I mean, within our own client data, we've got plenty of examples where in low payout years we don't see a reduction in the amount of PKE being fed, but we do see a reduction in the amount of fertiliser being put on. So now if we look at some of the data from our own clients based here in Canterbury. So what this graph is really showing is it's looking again at profit versus costs. So if we have, put it this way, so up here we've got profit, and over here we've got costs. So what it is, it's feed, plus it's also other costs that are associated with feeding. Because what we tend to find is when feed costs go up, the farming system gets more complex, we tend to spend more on wages, R&M and depreciation also go up. So what this is basically showing is that for a farmer that's spending $3 per kg of milk solids on these expenses, compared with a farmer that's spending $2, they're actually making $130,000 less on average, on the average size farm. We're a little bit sensitive on the going on. Am I in control? Right, so here we're actually sort of defining what a high-cost system versus a low-cost system is. So we divided our clients into thirds, basically. So the low-cost systems were spending less than $3.70 per kg of milk solids on farming working expenses, where the high-cost systems were $4.30 or above. And there is quite a variation there. But the sort of the biggest difference between those systems was how much they're spending on feed. So the low-cost farms were spending about 50 cents a kg of milk solids on feed, where the higher cost systems were spending $1 per kg of milk solids on feed. So that was the difference we've seen within our own data. Right. So if we look at the debt levels that we've got here in Canterbury, and this trend is not too different to the data I put up earlier, which was for all of New Zealand. So this is just the ANZ clients within Canterbury. So what we did see is during the sort of the really good high milk price years, debt didn't really decrease at all. But we found 83% of our clients increased their debt levels between 2015 and 2017 to manage through those low milk price years. So basically only 17% of the farms were resilient enough to manage through those years without increasing their debt levels, although some of the 83% may have also been expansion on farm and different systems as well. So here, we extracted some data out of our data, pasture utilisation, and compared that against profit. So what this is basically showing is that the more pasture you utilise, the more profit you make. And that doesn't really matter whether you're a straight grass fed system or a combination of grass and supplement. It also does show that there's huge variation from farm to farm in terms of pasture utilisation. And there's a clear trend there though. The more pasture that's consumed, grown and consumed, the greater the profits. And I kind of liken it a little bit to if I feed my kids ice cream before dinner, it's actually really hard to get them to eat their vegetables. So I think we've got a challenge here around how we do utilise, grow and utilise that pasture. Now I'm no on-farm expert, so I won't be telling you how you can do this, but there'll be plenty of other people here in the room who will be able to help you there. So at the moment we're in a really low interest rate period, so interest rates have been pretty low for quite some time. But what we would see if interest rates on our farms lifted by 2%, that would basically wipe out $165,000 off the bottom line on the average farm. So it is a risk. Interest rates around the world are rising, so it is something to keep in the back of your mind. And certainly it would have a greater impact on those who's in that original high cost group versus those in the lower cost group. So just to sum up before I hand over to Mark, I think what we'll see is milk price volatility will continue. With limited upside as we see competition from other markets come in when commodity prices are high, but we will feel the full brunt of the low cost periods. We have got upwards pressure on our costs in terms of sustainability, labour and debt, and the low cost systems do tend to be a lot more resilient, and certainly from our data, high pasture utilisation basically equals more profit. So I'll hand over to Mark now